All right, I'm going live. Hello, guys. Coming back to you with another FAQ Friday, frequently asked questions. And we're going to go ahead and get started. Sorry, running a little bit late today. Jonathan will be in here in just a little bit. But anyway, we wanted to go back and address some of the questions that were posed last week on our video last week about credit. So I'm going to pull some of these up, and I tagged a couple of folks here. Let's see, Christy Cruthis. Christy had a question about credit scores, and her question was, does a certain credit score determine what your down payment will be for a USDA loan? And Christy, that's a great question. Basically, the answer to that is with USDA, there is no down payment required traditionally. Credit score is a big factor with USDA. With that being a no money down loan, they typically want a little bit cleaner credit, a little bit higher credit scores. Technically, we can go to about a 620 credit score on a USDA. However, we find that the higher the credit score, the more likely you are to get approved through USDA, because they are looking a cleaner profile. They're looking cleaner credit, and so the higher that credit score is, the more probable is that you're going to get approved for it. So anyway, so that's a great question, Christy. Hopefully that answers your question. We also had another question here from Bonnie Heath. That's Jonathan's mother. General question, and her question is, what is better if your home is paid for, to do a mortgage loan, or if you have bills to pay off, consolidate? So basically, Bonnie's question is it a good idea to maybe take cash out of your home to consolidate bills? And people have different opinions on this, myself included. I don't necessarily like to borrow money against my home to pay off other debts. However, you can experience some significant savings on monthly payments if you do that, because you can borrow a lot of money and stretch it out over a longer period, a longer term, with a very small payment. So that can help quite a bit. So that's so again, people have different ideas about that. They have different thoughts on that whole process. But again, I like again, I'm not of borrowing money against my house to pay off debts, but again, it can produce some significant savings. In the past, I've done cash out refinances for folks, borrowed money against their homes that actually saved. I've had some save as much as $1,200 and $1,300 a month in monthly outgo because they just paid off those other debts. So it does help a lot in some cases. So that's the answer to Bonnie's question. So again, if you guys have any questions pertaining to credit, anything to do with mortgages, credit, real estate, post your question down below. And as we do these FAQ series, we will we'll address those specifically in the next one that we do. We try to do one consistently every Friday at noon, but we will be doing other Facebook Lives in there as well. Anyway, hey Tony, I see you, brother. We're going to address that probably on next Friday's video as well regarding the Worth account. But anyway, again, if you have any other questions regarding credit, mortgages, real estate, don't hesitate to put your comments below. We will go in and we will address those on the next live. Another question today that I want to kind of address is about credit scores and how it affects your interest rate. And that's a great question. We get that question quite often. Basically, with us as a lender, most of our programs start out at a 580 credit score and go up from there. And usually credit scores are done in tiers, so the better, whichever tier you fall into, and what I mean by tiers are, say, a 580 to a 600, 600 to 620, 620 to 640, right on up. And the higher you go on that credit score, typically the better rates you're going to get. So, say if you got a 580 to a 600 credit score, your rate's not going to be as good as someone who has maybe even a 640 or 660 credit score. Anything over a 740 credit score, typically you're going to get one of the better rates that's available at that time. So that's typically how that's done. It's in a tiering type system like that. So that is. Sorry, I forgot to put my phone on do not disturb, so I keep getting all these calls. But anyway, so hopefully that answers that question again. How credit scores affect your interest rate on your mortgage. Again, tiering and all about how again typically in tiers or pockets of 20 is typically how it's affected. So hopefully that answers that question. So anyway, hope you guys got some good information from this FAQ today. Hopefully it answers your questions. Again, if you have any questions about anything, just pop it down. Even after we go off live, just respond with any questions that you have. And again, as we do another one, we'll follow up on those and answer those questions for you as well. So hope you guys have a great Friday. Hope you have a great weekend, and appreciate you tuning in. See you soon.